Welcome to Vision Driven with Resin Architecture, the podcast where we dive deep into the world of architecture, development, and construction. I'm your host, Greg Croft, and my co-host is Jamie Moulton, and we are thrilled to have you join us on this journey of learning, inspiration, and insight.
When you talk about real estate, I would always recommend that you go into it with the exit in mind.
Advice I'd give somebody that's presenting their case or pitching their loan to a bank is just to be really well prepared.
Whether you're dreaming of building a space for your business or simply curious about the fascinating world of architecture and development, join us on this exciting adventure as we unlock the secrets to successful projects and empower you to turn your vision into reality.
All right, we're going to get started here. We're really excited to have you here with us, David. David is with Bank of Idaho. Tell us how many years you've been with them.
Going on 3 years.
3 years, and then in the commercial lending world or the banking world, how long have you been there?
Since 2000.
2000.
Out of
Okay.
School, graduate school.
Yeah. Okay, awesome. Well, so our goal is to help business owners who are making that transition from being just business owners to also being potentially building owners and kind of looking at that process. It's a different beast altogether. And a lot of them aren't familiar with it. And that makes up most of our clientele. And so we want to educate them in terms of, hey, these are the things that you should be looking at. And so today you're our banking expert. And the thing that we just want to cover that kind of stuff. So I guess my first question is, can you tell us about your background in commercial lending and maybe what that looks like in terms of, hey, I'm about to build a building or even purchasing a piece of ground to build a building on. Sure. Tell us a little bit about that.
Yeah, you bet. Getting a finance degree, I sold securities for a year and then figured that was pretty tough and wanted to use my finance degree, and I really enjoy sales. So commercial real estate loan officer allows you to really dig into the community and do a lot of work with a lot of the doers in the community. So I've really enjoyed it. I've done it for 20 years, 20 plus years now. And that's been targeting, helping small business owners, a lot of those who are contemplating and considering owning their own building versus leasing. So I have conversations around that really quite often. And then also with investor real estate, whether that's land development or vertical construction for investor properties as well. So pretty concentrated on the real estate. Throughout the career.
Tell us about how commercial lending has changed over the course of your career and what it's like now.
Oh, wow. I am getting older. I realized that when I preparing for this.
Experience is what we call it.
Yeah. When I first started, everyone was worried about the dot-com bubble, right? And interest rates, if you look at compared to where they're at now, they're actually pretty much on par where they were right around 2000, 2001, 2003. They were on the decline after worried about the implications of the dot-com bubble. But prime was at 6%. Recently, prime has gone up, but long-term rates were right around the 7.5% range where they are right now. And so that changed with the housing debacle. As far as what I saw, I never was directly involved with mortgage lending to consumers, so residential lending, but watching our industry be very loose in the types of loans that they provided, pick a payment, no amortization schedules, interest only, stated income, all of those things really led to probably pretty irresponsible lending. And I saw that firsthand. So a lot of banks failed because of that, and a lot of government funds had to kind of bail out the economy as well as banks. So that brought in turn a ton of regulation, Frank-Dodd Act, the Consumer Protection Act, and so that pendulum from being really, really loose in terms of lending really restricted on the other way, to where the regulatory environment on the commercial side, in even particular, tightened up so much that as lenders, I often felt like really good plan, pretty good loan to value. And I know they're going to make this work, but the ratchet had tightened down to where banks were constrained on what they could do. And that changed probably 11 and 12 and 13, and things started getting a little looser, and to where now I think most lenders have been pretty disciplined in terms of, and particularly land development. What kind of once bitten, twice shy, I think. But overall, we're in a pretty stable lending environment, particularly for our part of the country. The economy's been so good here in Eastern Idaho.
Kind of adding on to that question, just in the last few years with COVID, how has that affected like the commercial lending side?
Yeah, so COVID has probably benefited our region. There are a lot of coastal folks that work for really large employers in high rises in metro areas, whether that's Seattle or Portland or California, that have realized their employers have allowed them to work remotely. And so net in migration, like if you talk with a title company, that there's a lot of transplants here. A lot of, they call them political refugees too. They just want to get out of their political environment. So COVID has really probably benefited our real estate market here locally. A lot of move-ins.
What's something if you were talking to somebody that's like, hey, I want to do my first development, or I'm about to do this for my business, that they should actually be understanding about the commercial loan process?
Okay. Yeah. Well, I have that conversation again, like most weeks. The advice I'd give somebody that's presenting their case or pitching their loan to a bank is just to be really well prepared and understand the project itself, whether that's a new construction, having a good relationship with your contractor and or your architect to really get an understanding of what the end product is going to look like, and be able to voice and share how it's going to benefit your business. So if you're an operating business, an owner operator, being able to demonstrate how that new building or how a move from a lease to owning a building is going to help your business.
Okay.
Yeah, that's important.
What like you said, being prepared, what is that like? Is it just like, hey, have your tax documents ready? Like what is prepared?
Okay, as far as like on paper.
Yeah. So
yeah, bankers tend to make decisions on paper, right? Mm-hmm. So on paper, tax returns are scrutinized a bit. I tend to think of it as the front windshield is the future and the rear view mirror is the past, right? And so the litmus test for a lot of banks is, if you were to have this building the last 3 years, could you have afforded the payment? Mm-hmm. And so sometimes it's a bit of a stretch for operating businesses to say, well, yeah, I couldn't have, but my new building is allow me to increase revenues, increase profitability. I'm like a doctor, for instance, going from 4 chairs to 8 chairs, bringing on an associate. So be able to put those numbers down on paper. At the end of the day, banks are more cash flow lenders than they are collateral lenders.
Okay, so they're looking now at the rear view mirror and being able to see, hey, this is what's behind you, but then also looking at some projections in terms of like, is that a pro forma? What do you guys like to see in that?
Yeah, a pro forma income statement, where and how you feel a new building might help you with the revenues, okay, and how it's going to impact your expenses and your profit. Okay. Yeah, there's a few benchmarks in lending. One, just a pretty standardized benchmark in terms of what we measure for cash flow purposes is whatever your debt obligations are, your debt service, we want cash flows to cover those by the ratio is usually 1.25 times. Okay. And so we'll dig into the tax returns and and see how that ratio looks. If there's a little bit of wiggle room that you can afford it plus some.
So when's the right time for someone who wants to build a building to come to you? Is it once they have concepts from an architect, or is it before then when they just have an idea?
Yeah, so usually my favorite relationships as a banker are probably similar to your industry or a CPA, is one where you have a consultative relationship, one where you really know people's ideas and how their current decisions may be impacting longer term decisions. A building is a big decision. So maybe even a year or two in advance, hey, I'm thinking about it, getting an idea towards what type of a building they might afford. So definitely early. The earlier the better, for sure. Yeah. Now that doesn't mean if somebody gives me a set of plans, gives me their financial statements, and say we got some architectural plans here, we're ready to roll. We can roll up our sleeves and do that quickly too.
Is the land usually wrapped up into the building, or is that usually a separate loan?
Yeah, usually what we see is people's down payment, their equity, is they've owned the land for a bit of time. Sometimes it'll be cash where they've saved some money and inject their equity requirement, their 25% from cash. But a lot of times it's equity in the land. Yeah.
So likely they probably own the land outright in generally. And then architectural plans, usually that has some associated value that you guys will lend against as well, correct?
Yeah. So when you order an appraisal, lenders will base on a new build on an as proposed basis. So you shoot your stuff over to an appraiser and they'll give you a value at the end of construction and when it's stabilized. And it'll be based on the budget. It'll be on sales comparison approach as well as an income approach. Okay. And we use that to prescribe how much we'll lend against that collateral, against the land and building.
One of the things that you mentioned was that with, a lot of times people might come to you earlier and say, hey, or they might come to you before they work with an architect. They might come to you after they've worked with an architect. One of the things that we've recently on a couple projects, we're like, well, we don't actually know if this is a valid, from our perspective, we go through and we evaluate whether we want to take on a project based on the client, based on what we feel like they might be able to really do. Mm-hmm. And so recently we came up with a situation where we didn't feel like we were really comfortable with their knowledge and their actual ability to afford a project. And how do we, I guess as architects, it's not like we would typically say, hey, we want to work with you, but we want you to work with a bank to validate this before we spend a whole bunch of your money. But on the same note, if we're telling them that, it's almost a little bit offensive to be like, well, of course, like.
Yeah. Well, good architect is, I don't know if it's 6 to 10% of the project. Yeah. Ish, right? Yeah. And so that's a pretty large cost, right, and it's upfront. And so with good reason, it's good sound advice. I've run into at least a dozen situations where somebody's into an architect and they come and say, I've got a great design build. And they haven't come to me from a loan sizing an ability, and they've had to pare it down a bit, right, because they may be a little bit ahead of their skis, right, in terms of cost.
Yeah, that's a good way to say that. And that actually then it also results in some, hey, we had this building, it was this big, and now you're asking for what we would consider a change order. As we reduce that size, and part of that 6 to 10%, it's not just affecting the architect. As we make a design change, that's affecting the structural engineer and the mechanical engineer, electrical, plumbing, civil, all these different people that most of the time the client doesn't realize is actually involved on the project because we're the ones that typically hire them. And so then you end up adding even more cost to a project that now is reducing in size. So that 6 to 10% all of a sudden, because the project got smaller, now is looking at 7 to 12% or something because of these design changes. And so it's almost like we need to be working a little bit tangentially with a lot of different people at the same time. And so.
Yeah, that's very good advice. I call it loan sizing. Get with your banker, your CPA. Your CPA is going to have a very good understanding as to what lending parameters are for banks, credit unions, anyone that does real estate, and they'll give some good sound advice too. And then from a tax strategy standpoint, on the other end, real estate is such a tax strategy. There's so many ways that you can deploy tax strategies to decrease your tax liability, those type of things. So it really is to get a good idea to get a banker involved early in your CPA.
Can we, I know that this wasn't in our list of questions, but can we talk about some of those tax advantages just from a high level 30,000 foot view?
Yeah, I'm not a CPA, right, but in general, like a new construction, you can do cost segmentation. It used to be the GAAP rules would allow for maybe a 20 or 30 year depreciation schedule. But with a good architectural rendering, you can say we have this much in guts. We have electrical, mechanical that has a shorter useful life than the structure of the building. We have FF&E. We have our fixtures and our equipment. They also have a shorter lifespan, and so you can accelerate depreciation or do cost segmentation. And so if you're doing really well and don't want to pay a lot of taxes, you can accelerate what would normally have been just a straight line amortization or depreciation schedule. And that's been around for probably 15, 20 years, right, but used more and more all the time on smaller buildings. Right. Yeah.
Yeah. We have some recent, I personally have some recent, we did some cost segregation on a building that my wife and I had purchased, and yeah, it's a huge benefit. And they actually allow some accelerated depreciation. 2023, I think it drops to 80% of what'll get depreciated over up to 15 years. You can take 80% of that today.
Yeah. Yeah. So if you have a capital gain, you sell something, and you just had a really flush year, from an income standpoint, you can really plan around it.
Are there other tax benefits besides?
Yeah, there are. It's interesting. Over 20 years of lending in the commercial real estate realm, I see all of these huge net worths of people, 50, 100 million, $200 million, whatever, really strong net worth sometimes. And you look at their tax returns in the last 3 years, they've made $200,000 right, or whatever, because of all of the tax strategy for 1031 exchanges, rolling into your next project and building equity. And so it's the tax advantages to building net worth without taxes. That's been a takeaway for me just from the banking chair, mm-hmm, and seeing a lot of people really, really build a lot of wealth with the tax basis will come down the road. Their kids may have to deal with it, but it's for deferred basis. You can do that too through 1031 exchanges.
Yeah. Okay. On the commercial side right now, like what does a typical loan look like? What are different variants of that that somebody might have today?
Yeah. So,
and let's speak specific to owner occupied new construction.
Okay. Yeah. So owner occupied space, typically for new construction, banks will be 70% loan to value, or maybe 75. Okay. Whereas maybe a year and a half ago, that might have been 75% and 80%. So the constraints banks are starting to ratchet down a little bit on loan to value, but 30% equity to 25% equity should get you started with the conventional loan. If you're a growing business and want to preserve your cash to grow and deploy it for short-term needs rather than a long-term real estate project, You can utilize either the USDA program or the SBA program, or some farm-related rural area programs to come in with as little as 10% down.
And how does that work? Sorry, I keep cutting you off.
Yeah. So the SBA has two different loan types. One is where the participating bank, whether it's Bank of Idaho or another bank, approves it, and then they ask for a government guarantee. And the guarantee is 70% of the proceeds. And so banks are more willing to loan at a higher loan to value than they would normally. So you get an SBA stamp, and all of a sudden you can get 90% loan to value. And then there's another type of SBA loan where there is a development company. There's one in Rexburg, one in Pocatello, Twin, and Boise, and in Coeur d'Alene, to where they bundle up a debenture, and bondholders buy it, and they'll take a second lien position to the bank. And so the bank will do 50% of the project. They'll do up to 40% of the project, and you as the borrower only come up with 10%. Yeah, and we like it as a bank because after construction, they'll fund their debenture and take away, 40% of the project, and we're left with a first lien position at 50%. Yeah, and they take a second behind us. Yeah, and then USDA works fairly similarly. There's a tranche of money that's approved annually through the legislature, and those loans you get an 80% guarantee on. And so banks will go higher loan to values on USDA loans. Usually those have a little bit of a lower ceiling though, maybe 80 to 85%. Yeah.
Do you have anything to add about the barriers between first time building or the first time someone develops a building for them being able to get a loan?
Yeah. So typically it's the amount of cash in. Yeah. Or so if you don't quite have enough equity in your land, or you're cash constrained to come up with a down payment, that's typically the first barrier. Now, a good way around that is maybe through an SBA program. Not only will they allow you to put in 10%, but through one of their loan products, if you're a growing business and you can show that you're going to increase your body count in terms of employees and add to the economy, you can provide projections and say, not if you build it, they will come, but if we build this business, here's how our revenues are going to grow. Here's how our profitability is going to grow, and you can loan some on projected income. So not having a real good business plan in presenting that is a constraint sometimes too.
Well, those seem like easy to understand hurdles, so
Yeah.
they're easy to overcome, hopefully.
Yeah, on the investment real estate side, the hurdles right now are interest rates. So in our region, we're pretty lucky. So office space, industrial space, retail space, and those are the absorption rates over the last 3 or 4 years have meant that occupancy is like 92 to 95%. So when you're shopping for an income producing property, you more than likely have an opportunity to increase rents. There's increased pressure in rents. And this is coming at the same time interest rates are going up. And so typically loan to values are right around 75%. And in most lease income will still support a 75% loan. That is coming down on some property types, but overall here in Eastern Idaho, investment real estate is at a fairly normalized percentages. Now you consider nationally that's changed a lot, where there's been a lot of office buildings where people are gone. The occupancy rates are going down. And so with interest rates going up and lease rates going down in other markets, they're having to come in with a lot more equity. into these properties in order for them to meet that hurdle, that debt coverage hurdle.
Do you foresee those circumstances affecting our region in the future?
Yeah, we're somewhat insulated. I think some of the .com and the 2008, 2007 bubble, we were a little bit insulated here. I still feel like we have some insulation there. We do have some large kind of national firms that have, leases and such, but overall, I think we're as good a place as any. But yes, we have some exposure to that. And there was a lot of, usually commercial real estate loans have probably a 5-year reprice on the rate. So stuff that was booked in 2018 is now repricing on their loans. And what was probably a 4.5% rate at the time is now a 7.25% rate. And so you can imagine that being the case in a market where you're maybe have to make some concessions on rate on your lease space at the same time. So nationally, the crap hasn't hit the fan yet, but there's a lot of potential for some real problems nationally, and it could roll into here.
Yeah. I didn't think about the fact that they would have to be, re-upping those commercial loans, and the impact that would have they would be refinancing too, and they would have decreased the amount that they owe. So hopefully it's, generally that would have been hopefully a good situation where it's like, great, we get a reprice and we've got a lower overall loan amount. But in this case, it might be like, we're paying a little bit more for a smaller loan now.
Yeah. You can, what was maybe a 20-year loan 5 years ago is now you have 15 left to pay. Mm-hmm. You can, as a banker, refresh and do another 20-year loan to kind of reduce the payment a little bit.
And are you guys seeing that a little bit where people are saying, hey, we're going to reset that 20-year loan again, and just to keep things a little bit more manageable? Yeah,
not too much again around here, because tenants are having to pay more for their space. Okay. But I have seen where the interest rate is going to adjust, and they do want to reduce their overall payment. So they'll say, hey, let's re-amortize this loan, let's refinance it. Yeah.
Okay. How has your experience been working with commercial lending influenced your perspective on the real estate market in general? So 20 years, you kind of talked about.
I mentioned a couple of things,
but
yeah. So it's I'm like the plumber that doesn't do his own stuff right at home. I help all these people build well through real estate, but I haven't done any. It's a good thing that you're doing that. That's good. But I have firsthand seen, not that people are necessarily crazy smart, but just with a disciplined approach to commercial real estate have created passive income. Yeah. Passive income provides a lot of business owners I watch give their lifeblood to their business, their employees. It's a 24/7. I work with a lot of those, and the ones that own the real estate seem to recognize that at the end of this, I can keep my building, lease it out, and have some passive income at the end of it. So that would be one of the things that I've learned. And then just the position allows you to work with the doers in the community. The people are taking the risks, starting their own businesses. And so you learn a lot of just good things from people like that in the community. So those are some of the things I really like about the job.
Have you in 20 years, you've probably seen some of the people that are kind of hitting the end of that, where it's like, hey, I was the business owner for so many years, and now they're hitting that retirement age, but they still own the buildings. Like, what is your view on kind of those guys?
Yeah, just today I was having a conversation with a CPA. They represent they're a wholesale distributor to the construction industry. They sell product, and they're baby boomers age, and there's a ton of baby boomers, right? And so the folks that are buying their business are interested in the real estate, and they said, no, we just want to keep on to that because that helps them maintain their lifestyle. Right. And so they're getting $8,000 a month from their lease payment on the real estate from the tenant, and that allows them, pretty good income.
Right. And then they don't get hit with the expense of the taxes on that sale as well.
Yeah, that's right. Yeah, their basis is down so far because they depreciate. If they were to sell it, they'd have a big tax implication. Okay. Yeah, we see both. We see both ways. We see a lot of businesses trading hands too. In the U.S., I think it's many trillions of dollars that are going to be passing from baby boomers that are just done with their businesses, and then are looking for succession planning. Mm-hmm. So there's a large opportunity there for people that are going to buy a business to maybe get in over the last couple of years or the next several years, learn the business, and so a lot of businesses are trading hands and projected to, and that's a space that our bank plays in pretty heavily, mergers and acquisitions through SBA loans.
And on those, a lot of times, or what percentage of the time is the actual physical building or business, physical building going with that?
I'd say probably 25%, 20 to 25%.
So 75% of the time, either the owner of the business doesn't actually own the real estate, or they're keeping it and leasing it back. Okay.
Yeah.
Well, we always like to ask about your one takeaway. What is the one piece of advice that you would give to someone who is going to build their first building?
I would say don't be afraid about it. Really, look at it. Work with the professionals that can help you make an educated decision. But that would be your architect, and ensure whether it's a design build, your banker, your CPA, maybe your attorney. But over the years, in 20 years, I've done a lot of lease versus own comparables. And when you consider just kind of normalized appreciation, whether that's 4% or 5 or 6% in terms of real estate, versus the including the tax benefits of being able to expense your own interest, and then do some other tax strategy around appreciation, lease versus rent, it really makes sense to kind of own your own space. It does. I don't know if that'll always be the case. There's some tax law that may change, but I would say definitely look into it.
Awesome.
Yeah.
Well, we really appreciate you coming out.
Thanks for letting us do this.
If anybody wants to reach out to you, what would be a good form of contact?
Well, my email is davidfrew@bankofidaho.net.
DAVIDFREW. Okay.
Yeah. Just shoot me an email, and I'd love to help them. However, in whatever capacity I can.
Okay.
Yeah.
Well, awesome. Thank you.
Thank you. Great, Jamie. I appreciate the opportunity.
If you enjoyed this episode, please consider subscribing to Vision Driven on your favorite podcast platform so you never miss an episode. And don't forget to leave us a review. Your feedback helps us grow and improve our content, and it also helps others discover the podcast.
Remember, at Resin Architecture, we are dedicated to teaching and learning, and are committed to helping business owners like you navigate the exciting journey of building. Stay tuned for more episodes where we'll continue to bring you engaging conversations, expert insights, and actionable advice to fuel your real estate aspirations.